Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's very important webinar on key considerations in audit of retail sector. Retail sector is a very important sector these days, and there are so many considerations while auditing the retail sector. In order to tackle this, we are having with us our eminent speaker, eminent from our Chartered Accountant fraternity, C.A. Nilanjan Paulji. On behalf of AASB of ICL, I extend my warm welcome to you, Nilanjanji. Welcome to you, Nilanjanji. So, Chairman sir and Vice Chairman sir are stuck up in some important meeting.
Uh,
So, I will start with this your deliberation after introducing your brief profile. It is my proud privilege to share with all of you the brief profile of C. N. Nilanjan Paulji. C. N. Nilanjan Paulji is a seasoned chartered accountant with 15 years of post-qualification experience in a wide range of accounting and auditing matters. He has significant experience in assessing financial reporting implications arising from complex and judgmental matters such as going concern and non-compliance with laws and regulations. He is involved in providing point of view on emerging issues such as reporting under CARO 2020 complies under Companies Act and SEBI listing regulations. His experience in handling capital market transactions too, and he has publishes point of view on the emerging topics in leading publications having national presence and speakers at various forums of Institute of Chartered Accountant of India. He's an avid traveler and a serious photographer too. So without wasting much more time, I request Niranjanji to please start his deliberation. Over to Niranjanji, please.
Thank you, Anilji, for the warm and uh, good welcome. I also thank AASB for giving me this platform so that I'm able to interact with the fellow professionals. Really, thank you for this opportunity. So I'll start by sharing my screen. Anilji, hope the screen is
Yes,
visible to
sir.
everyone.
Perfect, sir. Perfect, sir.
Take Anilji. Thank you. Thank you. So the topic for today is the key auditing considerations for the real estate sector. Uh, and I think the timing cannot be more appropriate considering the festivities that we have just around the corner. So I think this is the perfect time when we delve into some of the key considerations which should be looked at when an auditor is looking at the financial statements of the real estate sector. So the way we have planned these discussions, we will provide an overview of the retail sector. We'll also look through the various auditing phases. We will discuss the considerations at the planning phase, the execution phase, and the report preparation phase. And obviously, we'll have some round of interactions with our participants. I hope we have a engaging session, and I hope to learn from all of you. So, as Anilji mentioned, retail sector is one of the very important sector of our country. It is the fastest or one of the fastest growing sector of our country. As a global footprint, India is the fifth largest preferred retail destination globally. From an Indian dynamics is concerned, the overall retail sector can be split broadly into two heads: organized retail, which will be our shopping malls, hypermarkets, or unorganized retails, which will be the next door shops in our locality. What I would like to highlight here is the unorganized retailing is still a dominant player in the Indian market. If you would look at the chart to the right hand side, even at a global level, the unorganized retails uh, in countries like China, Indonesia, Thailand, they do have uh, the dominant presence. What I could gather from publicly available information is that the level of concentration of unorganized sectors in India is quite significant. As the sector from the retail, are also the second largest employment generator. Uh, the sector generated around 35 million job opportunities. It has tremendous growth professional potential. It is estimated that the entire industry would reach to 2 trillion US dollars by 2032. One of the very important growth driver is the outburst of technology that we have in our country. E-commerce had been a game changer, and its market share has rose significantly as compared to previous few years. Again, that can be directly attributed to the usage of technology, uh, strong availability of telecommunication network, so on and so forth. On this slide, we will discuss about the commonly found business models. So obviously, the most common model would be of an independent retailer, somebody who has his own goods to sell, be it apparels, be it white goods, be it jewelry for that matter. And they would have their own store at various locations, which will have a strategic presence in a particular jurisdiction. There is also a possibility that instead of having their own stores, the manufacturer will sell it to the dealers or distributors, and the dealers or distributors would in turn interact with the end customers. So in this model, what happened is that the manufacturer would provide license, sometimes an exclusive right to the distributors and dealers to deal with their products. Next could be a very common model which we see in a shopping mall where the premise is managed by somebody else, whereas you will have some outlets present of various and a large range of retailers. Uh, Next would be a e-store or an online store. So this is just instead of having a physical presence, you have a digital presence where any customer can log in to your website and place products, and those products would get delivered to the suggested location of the customer. Franchisee systems are also in vogue. For example, if you want to have the distribution rights or the franchisee rights of a fast food joint, so you would set up a particular premise. You would have your brand agreement from the brand provider. You would pay some bit of royalty to the brand owner. However, the entire revenue from sale or services would be vesting with the franchisor. Last but not the least, there is also a concept of aggregator. Aggregators are a platform where the seller and the buyer would interact, and they would place order amongst themselves. So aggregator is only an umbrella where it helps both the buyers and the seller to meet and initiate business transactions. Now, I thought I'll just lay out certain of the special features of this sector. This, I'm sure, would help us when we deliberate in detail about the nuances of the retail sector from an auditing perspective. One aspect which you all would appreciate is that a retail sector is bound to have multiple stores, right? So they will have a location in most or some of the key locations of our country. As a result of spreading of their goods and services, they would require to have a very robust monitoring mechanism, to safeguards, especially the inventory part. Now, one of the very important feature of locational stores is that the store should have a locational advantage or a business intelligence. So that is an absolute key for any store. So imagine if you're having a store in the heart of the shopping area, you would expect the footfall to be much more higher as compared to a store which would be located in a far off place. This industry is also quite labor intensive. You require a huge degree of a huge quantity of manpower to monitor and safeguard various various processes and look at inventory levels in particular. You also need trustworthy people, especially when you are dealing with uh, things like jewelry, as they are very high value and they also carry an inherent risk of of manipulation. The entire sector would require an efficient use of management and delivery system. So if you don't have uh, a proper sourcing model or a proper delivery model, the business is expected to suffer. Now, the last point I think is the most critical factor. It actually is reflective of the entire retail sector, which is the customer preference. So each and every location will have its own preference. For example, a store in North would have a very different customer requirement to from a store in South or from the West region of the country. So you could imagine the level of detail and the level of business intelligence which an operator of a retail unit or a retail store would require to have a successful business. So as a result, these would obviously impact the auditing considerations, and we would see in the subsequent slides how they impact throughout the phases of the audit. So let's begin with the planning phase. Planning phase is where the auditor is expected to plan for the audit. The auditor is expected to develop an audit plan and an audit strategy. Now, two important considerations which an auditor is expected to carry out at this phase is to identify the risks involved in that particular engagement, and secondly, the determination of materiality. So if I talk about the first stage of risk assessment, an important part is to understand the business of the entity. So if you are going to audit a retail entity, y- the auditor is expected to reassess his knowledge and understanding of the entity, identify events which would have happened during the year or expected to happen right after the balance sheet date, the transactions and other matters which will have significant effect on the business, which will have a consequent impact on the inherent risk and control risk of the entity. So when an auditor is understanding the business, it is quite possible that this is the first time audit of a particular client. So in that situation, it is always relevant that he engages with the client at the very early stage so as to iron out any implementation challenges. So when the auditor is understanding the business, I thought there are that there are three particular matters that should be considered in developing the audit plan. First is understanding the nature of the entity and its environment. So, for example, uh, what is the comparative environment of that particular entity? Let's say there is a new player which has uh, which has been introduced in the market. What is the effect of the dominance of that player in my demand, in the capacity, in the price that I can command from my customer? Is it going to have any negative indication? Whether there are any changes in legal or regulatory framework. So, for example, if there are new statutes which have been pronounced, or there are uh, new judgments which have been passed by the Supreme Court or by the locational courts, that should also be considered by the auditor when understanding the business environment. The auditor should also assess whether there have been any changes in accounting policy, especially the policies which deal with judgmental and significant matters. For example, customer discounts or customer loyalties. All these are prone to forward-looking information. So if there is a change in the accounting policy, the auditor should consider them at the earliest so as to understand the nature and the inherent risk. Second consideration that should be applied by the auditor are the transactions with related parties and their relationships. So particular attention should be paid whether there are parties which are in a position to exercise dominant influence by virtue of their control or significant influence. So for example, if there is a dominant shareholder and if I am transacting with the shareholder, then the auditor would assess the susceptibility of the transaction to any potential misstatements. The auditor should also assess whether there are fraud risk involved in the related party relationships or transactions. Next, while understanding the business, the auditor should also assess the going concern assumption of the entity. I would like to highlight here that we have just come out from the effect of COVID-19 pandemic, and we have witnessed very severe business disruptions, not only in the retail sector but in the economy in general. So, when the auditor is assessing the implications on going concern, the auditor should assess if there are any still remaining effects of COVID-19, especially if that is the reason for recurring operating losses, or if that is leading to any other factors. For example, due to business disruptions, whether there are downgrade of the credit rating facilities of the entity. It is also possible that a potential business failure, let's say a particular store in a very important location, is an indicative of fraud risk. So net, when the auditor is trying to understand the business, these are the key aspects that should be considered by the auditor at the planning stage. Now, how should the auditor actually execute or understand these aspects? So one way to do that is to reassess the information the auditor would have obtained from the client during the engagement acceptance and audit proposal stage if it is a new client. So he or she should go back and reassess the relevance of that information in the context of the audit that they are going to perform. The auditor should also refer at industry publications or any other information which is available in public domain, just to get a sense as to what are the key matters that are affecting the industry in a both positive as well as adverse way. The auditor should also read the relevant minutes of the meeting, including the minutes of the board, the management, and the shareholder. The auditor should also perform inquiries with the management, especially with employees who are involved in complex or unusual transaction. For example, there is a new merger of an entity which is under IBC that has happened in the current year. So, what are the nuances? Whether the accounting policies that has followed by the erstwhile entity is appropriate or not. That could be a point of deliberation which the auditor should consider. Inquiries with in-house legal counsel as to the litigation claims, compliance with laws and regulations, if there are any new business arrangement, should be carried on by the auditor. The auditor should also inquire with the marketing personnel. For example, if there are any changes in marketing strategies, you would appreciate that considering the dominance of the customer preference, many of the brand providers involve marketing through various celebrities or various sports person or any person who is of eminence. So when we are understanding the business, we should also inquire with the marketing personnel if there are any new agreements that have been entered into, whether there are any agreements that have been cancelled or they have been pre-terminated, and whether they have been considered appropriately by the management while preparing the financial statements. Another way to understand the business is to observe the entity's operation by visiting those strategic facilities. I would not expect the auditor to visit each and every location, but the locations which are of strategic importance may be considered by the auditor while developing the audit plan. The auditor should also inspect the MIS or interim information of the those charged with governance in order to find out the audit plan. The next aspect which I thought would be relevant here is the determination of materiality. So, materiality is an important consideration for the auditor because an item is material should be very appropriately included in the financial statements so that the financial statement display a true and fair view. Now, why I believe that the computation of materiality is important, again, because of the effect of COVID-19. So, normally when a materiality is determined, a percentage is applied on a benchmark. Now, that benchmark could be revenue, it could be assets, it could be borrowing, it could be expenses, and it will be and it is entirely dependent on the way the entity is managed. So since we have been witnessing the impact of COVID-19, it is very important to find out which year would be comprising a normal year in that sense, and probably some adjustment to that benchmark can be used by the auditor to compute the materiality thresholds. Needless to say, materiality can be determined for the financial statement as a whole, or it or materiality can even be determined for particular financial statement captions or disclosure. The standards on auditing provides utmost flexibility to the auditor to compute materiality. But the message which I want to pass on here, that when you are computing materiality, look at the benchmark, which is a much more normalized benchmark, which don't have the effect of COVID-19, and obviously that number or that benchmark should be adjusted based on the current facts and circumstances so as to compute the appropriate materiality level. Next, if you move on to the execution phase is where we actually carry on the test of controls, test of details, and various substantive procedures. We also assess the design and operating effectiveness of internal control while performing an audit of the financial statements. Now, the one of the important uh, perspective that should be looked at by the auditor is the is around the revenue recognition. So, as we all know, revenue recognition has a presumptive risk of fraud. So, under the standards on auditing, unless the auditor is able to rebut a particular uh, in a particular situation, by default, the revenue has a risk of fraud, primarily because there is a risk that revenue can be overstated. Another reason why revenue is susceptible to fraud is is that if there are weak or insufficient controls. Now, because of these insufficient or internal controls, the underlying risk under the financial statement caption of revenue would be further accentuated. Uh, the structure of the entity could also play a major role in the revenue recognition considerations for an entity. If the entity has a decentralized structure, it would it would require a greater emphasis on internal control, and hence it will have an impact on revenue. Lastly, timing of revenue recognition would require a critical assessment. It should be looked at whether the revenue have been recognized in appropriate time, whether there are issues on cutoffs, etc. Now, if you would look at the boxes below in yellow, you would see that there are certain considerations which I've highlighted specifically. So, in our experience, when we are looking at the revenue recognition of a retail estate client, we might watch out for items like channel stuffing. So what does this mean is that if a customer has placed an order, let's say for example of 100 units, the entity uh, might supply, let's say, 200 units. So as a result, what would happen is that I would recognize revenue of 200 units at the end of the reporting period. Now, subsequently, what would happen is that since the customer would not have requested for more than 100 units, they would return those goods. So as a result, the financial statements would not be appropriately presented because the revenue would be recognized in a particular year, which is obviously overstated, and the sales return would be recognized in the next year. We should also watch out for cash skimming. This, in a very normal term, are known as cash defalcations, where the cash is not reported in the financial statements, and ultimately the trade receivables are either provided for or written off from the financial statements. We should also watch out for bill and hold transactions. Bill and hold transactions are where the items are billed, but they are still held back by the seller on the request of the customer. So we should be very careful if there are instances of bill and hold transactions at the year end. We should actually probe and inquire whether the control or the risk and reward of these goods have been transferred to the customer or not. Now, what would be the key auditing considerations when revenue is being audited? So, obviously, we would check the systems, procedures, and the authority to fix prices, the authority to offer discounts, and other terms and conditions. The auditor should go back and check the selected entries in the sales journal with the underlying documents, for example, the sales order, dispatch documents, or other supporting documents, and the receipt of cash. The auditor should also inspect sales or distributors uh, dealer agreement and see whether the revenue from such sale is not recognized unless the timing for revenue recognition is met as per the accounting policy followed. So let's say the terms and condition requires that revenue recognition criteria is met when the items are reaching the doorstep of the customer. So unless the criteria is met, revenue recognition cannot be done only at the time of revenue, the time of invoicing. We would need to wait till the time we get a confirmation that the goods have reached the customer location. The auditor should also carry out cutoff procedures for sales and sales return. The auditor also might consider carrying out various analytic procedures. For example, comparing location-wise or store-wise revenue for the current year with the previous year, comparing ratio of trade discounts to sales to the current year and to the previous year, compare location-wise or store-wise quantity for the current year with the previous year. Uh, Moving on to the next slide, since we said that revenue recognition is has a presumptive risk of fraud, it is also important that the auditor should frame anti-fraud procedures. So I thought I will just highlight a couple of the key uh, anti-fraud procedures which the auditor might consider. For example, to mitigate the risk of fraud in revenue, the auditor might seek confirmation, balance confirmation from customers, including the terms of sales agreement, absence of right to return, and what are those terms and conditions which might restrict uh, the immediate revenue recognition. The auditor could also be physically present at one or more location and also perform appropriate cutoff procedures. Another important way to mitigate the risk of fraud is to build in unpredictability in audit procedures. So these would be very case specific and situation specific procedures which the auditor should consider in order to mitigate the risk of fraud. From timing of revenue recognition, the auditor should understand the terms of revenue recognition um, and for significant revenues. So the auditor can review the underlying contracts and look at critically the terms and condition of transfer of control or risk and rewards. The auditor might also consider performing procedures with a lower testing threshold relating to revenue. Example, by comparing revenue reported monthly and products, business segment during the current period and the prior period. The auditor should also consider modifying the procedures basis the specific facts and circumstances and the management explanations as and when provided to the auditor. Uh, this is a recent development which I thought I should highlight, and more so because we also spoke of obtaining confirmations. So ICI has issued an advisory on the procedures to be followed when an auditor is planning to seek external confirmation through third-party vendors. So in this regard, ICI has noted that in some cases, the use of third-party vendors had led to risks that the information provided by the third party may not be authentic. It was also unclear that who would be responsible in case of failure of control at the end of the third party, which will again question the integrity of the information provided. More so, there is no legal framework or guideline in this particular case. So, as a result, the auditors are exposed to serious risk in case uh, the auditor is planning to use a third-party vendor to obtain a balance confirmation. So, keeping these views in mind, ICI has issued an advisory and they have advised the auditors should seek direct confirmation from the concerned bank. So, I thought I will just highlight. So, if you're planning to seek balance confirmation of your from your customers or vendors, you may like to consider the ICA advisory. Next important consideration is the customer loyalty program. So, as you would recall, when you go to a particular retail outlet or a particular shopping mall, at the time of payment, you would give your credentials. They will raise invoice, and and when you go home and check, you will get a message that certain points have been created in your account. Now, these are called customer loyalty points, and they are designed to encourage repeat business, offering people a reward for their store or for a brand loyalty. Now, from these customer loyalty points, the customer can get discounts or can obtain special incentives from the stores. What I would also like to highlight is that these customer loyalty programs help the customer to entitle them for free or discounted goods, not only in that particular store or maybe in any other stores of that particular chain. Now, what you would also appreciate is the usage of these point is very person specific. So somebody may like to use it at the time of festive season, or somebody might like to use it as and when the time passes. But the aspect of redeeming these points requires a huge degree of judgment by the management. And accordingly, when the auditor is auditing this particular financial statement caption, the auditor would also need to look at the underlying judgment and assumptions. From a accounting standpoint, the allocation of revenue between goods and the credit awards would also require consideration, and the auditor should go back and check the accounting requirements in that matter. Now, as far as the key considerations are concerned, normally what I have seen is that in case of estimates, uh, uh, the management develops a model. So that model could be based on historical trend, or it could even involve getting an expert to prepare a model for you. Now, irrespective of that, the auditor should test the management model. The auditor should start by uh, by asking the management rationale for the appropriateness of the model and method used, and whether this particular model has the same accounting implications, whether they are in line with the accounting implications that should be considered by the auditor. The auditor should also evaluate the theoretical soundness of the particular model, accuracy and completeness regarding the data and assumptions, the output compared to the actual transactions. So sort of a variance analysis to see whether the model is giving the desired results or not. It might also be possible that there are more than one models in vogue. So when there are when in such a case, the auditor should check the range of significantly different estimates and discuss with the management what are those considerations applied so as to pick up the outcome from the multiple models. It is also important that the auditor should check the underlying data. So as far as the internal data is concerned, the auditor should verify that the internal data is relevant and complete and accurate. The auditor should also consider that the data that have been used have been understood in the correct context. So, for example, if the data is used for a particular type of product, in order to find out the usage of the customer point, it is important that the data or the underlying data is also used in that context. The auditor should also test the significant assumptions that have been used by the management. Most importantly, whether those assumptions are inconsistent with the applicable financial reporting framework, be it Ind AS or be it accounting standards, whether they have been changed from the prior period, and especially what are the reasons for the change. Let's say till last year, the management felt that out of the closing points, the customer would immediately use, let's say, 10% of those points. Now, in the current year, the management believes that probably 15% is much more representative. So, what is the rationale for that change? Should be looked at and evaluated critically by the auditor and documented accordingly in the audit file. The auditor should also perform some sanity checks. For example, the consistency of the significant assumptions within the estimate. So let's say the same information is used more than once in developing the estimate model. Whether the estimate or the assumption is consistent, that should be looked at. Whether the assumption is also consistent with other estimates. For example, whether the growth of sales that have been considered while developing the estimate for customer loyalty program, whether that is in line with the assessment of impairment of the entity. That kind of a consistency check should be done by the auditor. Again, from a may broad perspective, the auditor should check whether the assumptions used in the business are in relation to those used in other business by the entity. Now, when we are testing the management estimate, one of the very natural reaction is of a management bias. So, since these are judgmental matters, it is very common that the estimates and assumptions are prone to management bias. So, a couple of them I've highlighted on this slide. For example, anchoring bias. So, it could be possible that while developing the estimate, the management is placing too much reliance on one particular set of information. That is known as a anchoring bias. Next, it is possible that where certain information is actively gathered, the management considered them to be more persuasive because they're consistent with the initial understanding or expectation of the management. Next could be an availability bias. What does this mean? Is that the management could consider information that is more readily available and follows the view of others as more relevant or more important. This means that in this particular situation, the management doesn't do a thorough analysis of what could be those factors that could affect a particular set of assumption. They they might only be biased by using a particular set of information which is very readily available. Similarly, there is also a familiarity bias, which is basically the preference of individuals to a certain set of information which are familiar to them. Again, so when an auditor is auditing the estimates involved in the financial statements, they should very clearly watch out for management bias. So how should the auditor do that? Very importantly, the auditor should exercise heightened level of professional skepticism, and this can be attained by obtaining an understanding of the accounting estimates and related disclosures and comparing with our expected amounts. The auditor can also design and perform procedures in an unbiased manner. They should also consider all relevant audit evidence, whether corroborative or contradictory. So it might be possible that when the auditor is gathering audit evidence, there would be certain set of information which will confirm the position of the management. What is most important is that the auditor should also look at information which is contradicting the management assumptions or judgment. So that's what I mean is that the auditor should perform procedures in an unbiased manner. They should look at the entire audit evidence holistically and then take a call whether the estimates or judgment is relevant or not. The auditor can also assign senior team members who have appropriate experience and knowledge in particular item, especially the management judgment section. That would also bring in a level of maturity in the audit procedures. Next consideration which the auditor should look at is the inventory verification. As we also discussed earlier, uh, the retail sector is expected to have multiple types of industries, sorry, multiple type of inventories, and it could have inventories in varying categories. For example, if it's a store for air conditioner, I might have air conditioners for different brands, and that too of different sizes, which is further split into various price ranges. Festivities pushes the inventory level, and hence the risk of loss of inventories at this particular point is heightened. Uh, Inventories are also spread across multiple locations. Um, so there could be multiple sales point or dispatch points, which again raises doubt on the safeguarding of the inventory. Again, the inventories are also susceptible to shrinkage. It's a very common term which is used in the retail sector. Shrinkage means it's a loss of products due to a combination of theft, shoplifting, or under-delivery by customer. So again, since the items of inventory uh, are uh, are are wide-ranging and they are available at open space, they are susceptible to shrinkage. So when the auditor is performing the audit procedure, they should perform procedures so as to mitigate the risk of shrinkage in its audit. So one way to look at the inventory is to perform an inventory count. I would like to highlight that the counting of inventory is the responsibility of the management. The auditor is not responsible to perform inventory count, but are responsible to observe the entity's method and perform test counts and test the reliability of entity's accounting records, procedures, and relevant controls. So while performing the while considering the inventory count, the first step is to plan for the inventory count. The auditor should consider the instructions the management would have issued. I would also like to highlight at this particular point in time is that from a CARO 2020 perspective as well, the auditor has a specific responsibility to comment on the inventory count procedures established by the management. Accordingly, consideration of the instructions that have been issued by the management is quite critical for the auditor. While planning for the inventory count, the auditor should identify location which requires specific attention during or even after the physical count. If possible, the auditor should select the inventories beforehand so that they could carry out a much more effective inventory count um, on that particular day. The auditor should specifically check whether procedures have been instituted that no goods are counted twice. Normally, this happens by way of tagging. So, if there are tags which the management proposes to use, the auditor should verify the tag count and look at the appropriateness of the tagging procedures. In some cases, there could be electronic machines which might help to perform an inventory count. So in that case, the auditor should plan for procedures, for example, using of electronic scanners, so that the auditor can effectively trace the final count uh, as per floor with the books of accounts of the entity. Now, while observing inventory count, the auditor should observe inventory at certain location on an unannounced basis, or try to conduct all count of all locations on the same date. What happens is that this brings an unpredictability in the audited procedures, and as a result, the auditor is able to obtain a much more stronger set of audit evidence. Another way to improve or increase unpredictability in the audit procedures is to perform a combination of physical count as well as virtual count. So, it is possible that the audit team physically performs the inventory count. Uh, Another team from the office or from any other location can virtually look at the inventory location or suggest additional inventory count items that might then be verified by the personnel who are there on the ground. Uh, Again, from a sanity check perspective, while performing the inventory count, the auditor should examine rigorously the content of boxed items, the manner in which they have been stacked or labeled, and look at the quality or purity of the particular item, especially for liquid substances, for example, perfumes, and so on and so forth. For locations which are unobserved or where the inventory count has not been performed, the auditor should obtain a copy of physical inventory and assess the reasonableness of those inventory. The auditor should also corroborate and look at the purchases and sales from that location. This will also help to assess the reasonableness of the inventory count. The auditor should also vouch the activity in the inventory account since the physical count has happened. So let's say the inventory count has happened on 31st of March. What have been the subsequent movement should also be looked at by the auditor. The auditor might perform analytical review procedures such as comparing the current account balance with the prior period, do a trend analysis, and other type of analytical review procedures. Cash receipts. So the next important aspect which I would like to highlight is the receipt of cash at various stores or various supermarkets or hypermarkets. I would like to highlight that cash sales still plays a dominant role in the retail sector. Uh, on an overall basis, approximately 50% of the sales proceeds happens in the form of cash. Though through the use of digital medium, the receipt of cash has gone down, but even today, in my experience, the cash receipts still plays a very large role in the sales proceeds of the products. As a result, this also raises a certain level risk on cash, which is about the defalcation of the cash. So let's see what are those considerations the auditor should apply when auditing cash receipts. Now, if you would visualize any particular retail store, you, uh, you could see that the cash register or the area where invoicing is done or billing is done is completely separate from where goods are kept. Uh, there are also alleys where the customer would follow that alley and get their products billed. So we might not appreciate those thing when we go there and buy our products, but I would like to highlight that these aspects are some of the very important internal control factors that are implemented by the entity. So when you are auditing a particular entity in the retail sector, they should verify the store layout and check whether the customer passes through the area where the goods are kept, or the goods and the billing area is completely different. If there are blind spots, whether those blind spots are covered by cameras or mirrors. The auditor might even consider verifying the the pre-employment background checks of the employees who are handling cash, just to identify um, uh, any employee of a questionable background. The auditor should also verify segregation of duties. For example, the person who is receiving sales proceed, whether he or she is also being involved in making a bank reconciliation or a cash reconciliation, or whether he or she is also involved in depositing the daily cash with the banks. If there are no segregation of duties, the auditor should consider when assessing the implication on the internal financial controls of the entity. The auditor might also consider counting the cash in front of them, or could even look at the procedures which the management would have instituted. For example, whether the cash is being counted by someone other than by the cashier on a periodic basis. Some other procedures which the auditor might consider. For example, the auditor might audit after each shift the receipt of cash and then compare with the total of billings raised before the shift of that particular individual ends. The auditor could also carry out surprise cash verifications uh, more frequently, and ascertain whether the actual cash on hand agrees with the balance shown in the books of accounts. Now, as I said, e-commerce entities are leading the growth in the retail sector. So as a result, it is important that we also talk about the auditing considerations for e-commerce companies. Uh, Normally, the e-commerce companies are deal with various electronic sources such as the internet. This involves real-time processing of business transactions, either at a B2B level or a B2C level. Now, because of the e-commerce, they have introduced new elements of risk, which should be addressed by the entity and considered by the auditor while planning and performing the audit of financial statements. So let's see what are those considerations are. What I would like to highlight is that the effect of e-commerce on an audit would vary based on the complexity and the e-commerce activities of that particular entity. Where the concentration of e-commerce activity is quite significant, the auditor should understand the risk involved in the entity's use of e-commerce, the entity's approach to managing those risks, particularly the robustness of internal control system, security infrastructure, data leakage, and also if there are any implication of such matters on the financial reporting process. The auditor should also consider the effect of entities' dependence on e-commerce activities so as to assess the implication of going concern. So let's say a large majority of the operations is an e-commerce type of operation, and that particular mm, business segment is not performing well. In that case, the auditor should assess the implications on the going concern. Since these activities are much more technology driven, the auditor should assess the appropriateness of accounting policies. For example, capitalization of expenditures such as website development, complex contractual arrangements, whether this entails a principal or an agent relationship, or what are the considerations while assessing the timing of revenue recognition. The auditor should also assess the reliability of the system and use and capturing and processing the information regarding the integrity of the information in the accounting system. The auditor should also assess non-compliances with taxation laws and any other legal or regulatory requirement. Uh, it could also be possible that the auditor may use the work of an auditor's expert because the auditor may not be an IT specialist. In such case, the auditor should involve an IT expert at the inception stage itself, so that they can guide the audit team from identification of risk and potential mitigating factors. Next important consideration is the compliance with laws and regulation. Here also, management is responsible for conducting the entity's operation in accordance with applicable laws and regulation, uh, including uh, including compliance with the laws and regulation that determine the amounts and disclosures in the financial statements. So there could be certain set of laws and regulations, for example, the Companies Act or SEBI, which will affect the recognition, measurement, and disclosure of transactions in the financial statements. That should obviously be considered by the auditor. What should also be important is that the laws and regulations which may not directly affect the financial statements but have a potential of a material misstatement should also be looked at by the management and also by the auditor. The retail sector is governed by various laws, including contract laws, competition laws, customer protection law, intellectual property, employment laws, so on and so forth. I have listed out some of the key laws and regulations which might be of relevance for your audit in a retail sector. For example, the Essential Commodities Act, the Agriculture Produce and Cess Act, the E-Waste Rules, Essential Commodities Act, and Standards and Weight Measure Act. In particular, I would like to draw your attention to the Environment Protection Act and the E-Waste rules. So what has happened that in the past few years, when the government is also pushing for its green initiative agenda, they have instituted the e-waste rules. In this particular laws and regulation, the entities who are manufacturing electronic goods are supposed to take a particular percentage of their electronic goods from the market when those products have reached their end use. Now, as a compliance with laws and regulation, the auditor should also assess the accounting implications, especially the disclosures and making of provisions of such e-wastes. Now, from a auditing standard perspective, the auditors are not responsible for preventing non-compliance with laws and regulations, and are not expected to detect laws and regulation with every non-compliance with every laws and regulation. As I said, management is responsible for ensuring compliances with laws and regulation. As far as the auditing considerations are concerned, the auditor should perform inquiries with the management and those charged with governance. For example, they should inquire about the terms of operating licenses, whether the business carried on by the management are in line with the operating licenses. Whether there are any particular state laws or regulation which might affect a particular entity should also be inquired by the auditor. Uh, the entities or stores which are dealing with health or safety matters, for example, uh, controls relating to maintenance of the hygiene of food items. What are those controls that should also be inquired by the auditor? In particular, the auditor should inquire about the policies that has been established by the management to prevent non-compliances with laws and regulation. In addition to inquiries, the auditor should also be alert to potential non-compliances. They should identify whether the management has self-reported a particular instance. Um, I would like to highlight that in certain cases, the listing regulations under SEBI would require the management to disclose certain information to the stock exchanges. So the auditor should remain alert and verify whether there has been such disclosures by the entity. Uh, the auditor should also assess whether there are any ongoing investigations, findings in any of the regulatory agency reports. In particular, the auditor should also check whether there have been unspecified or unusual services or loans, including large amount of loans. So especially if a loan has been given to the group entities or anybody outside the group entities, the auditor should critically assess the compliance with applicable laws and regulation, especially the Companies Act 2013 or the SEBI listing regulations. Uh, the auditor should also be alert about transaction with related parties, whether those transactions are particularly above or below the market price. From a media intelligence perspective, the auditor should consider the information which is available in public domain, be it press, be it social media, or internet searches. Lastly, the auditor should also look at whistleblowing allegations, if any. At this point, I would also like to highlight that whistleblowing considerations are also required to be evaluated by the auditor when commenting on CARO 2020. So, firstly, the auditor should verify whether the company has instituted a whistleblowing mechanism uh, under the Companies Act 2013 or under SEBI regulation. Certain entities are required to mandatory establish a whistleblowing mechanism. The auditor should verify the robustness and the manner of operating such mechanism, especially uh, whether there have been procedures established by the management to to limit or to avoid victimization of whistleblowers. What are the status of the whistleblowing allegations? Whether they have been looked at closely by the management, whether they have been reported by the board, and what are the views of the board should also be considered by the auditor while assessing the compliance with laws and regulation. I would also like to highlight that effective October 2022, the ICI Code of Ethics, to the extent it relates to responding of no-clause provisions, have also been made effective. So, if the auditor uh, identifies any non-compliance with laws and regulation, they should look at the Code of Ethics and especially the section which deals with responding with no-clause provisions. Now we are at the last stage, which is basically the auditor's considerations when they are preparing the auditor's report. So at this stage, the auditor would look at the effect of the all procedures on the audit opinion. The auditor would verify whether he or she has been able to obtain sufficient appropriate audit evidence so as to reach an consensus. What are the misstatements that have been identified in the process? How many misstatements are material? How many deal with internal control considerations? uh, Whether there are any misstatements as far as the disclosures are concerned, whether there are any non-compliance with the laws and regulation that should have an implication in the audit report. So this is the conclusion stage where the auditor would need to conclude on various matters that have been encountered in the audit procedures. Now, one of the very key item that should be looked at by the auditor is the going concern assessment. I would like to highlight that under the Companies Act 2013, the financial statements of an entity should be prepared on a going concern basis. Now, what this means is that it is always expected that the entity would continue on a going concern for a foreseeable future. So at this point in time, there is no indication that either the entity would materially curtail its operation or it will go for a liquidation. Now, as far as the auditor's responsibilities are concerned, the auditor is required to assess the appropriateness of management's use of going concern basis of accounting, and especially whether there is a material uncertainty regarding the entity's continuance as a going concern. So, for our discussion purpose today, I have highlighted certain events or conditions which might cast doubt on the continuance of the entity as a going concern. At this juncture, I would like to clearly articulate that it is not that if the entity has met one of those uh, conditions or events, it raises doubt on the going concern of the entity. When the going concern of the entity is assessed, it is evaluated on an overall basis. So it could also be possible that out of the examples which is there on the slide, the entity uh, attracts one or two going concern triggers, but that on its own doesn't mean that the going concern assumption is not correct. So the auditor should look at the mitigating factors and look at the robustness of those mitigating factors so as to conclude on the going concern. So what could be those going concern triggers? So let's say from a financial side, uh, it, it could be possible that there is a net liability position or there is a net current liability provision, meaning the current liabilities or the total liabilities exceed the total liabilities or the current liabilities of the entity. This again raises doubt on the liquidity position of the entity because the entity would have less resources to settle its obligations. If there are indications of withdrawal of financial support by creditors or by fund providers, this will ultimately choke the liquidity position of the entity. Whether there are negative operating cash flows, uh, in that case, the auditor should look at the cash burn and see how much cash the entity would need to meet its operation for the next 1 year. If there are adverse key financial ratios, the auditor should consider them as a going concern trigger. I would like to highlight that from a Schedule 3 perspective, there are certain ratios which the Companies Act 2013 requires the entity to disclose. So again, from a going concern assessment perspective, it is very important that the auditor looks at and evaluates those ratios. From a operating front, if there are intentions of the management to liquidate the entity or cease operation, that is obviously a very clear indication of a entity not wishing to continue as a going concern. Whether there are loss of key managerial personnel and the entity is unable to find a replacement, so in that case there is a talent gap, and hence the ability of the entity to operate comes under question. If there is a loss of major market or key customer, franchisee, license, or principal customer or supplier, that should also be looked at by the auditor in this particular fact pattern. Now, there could be other indicators, for example, non-compliance with laws and regulations. If there are pending legal or regulatory proceedings, that would affect the continuance of the entity, should also be considered by the auditor. Now, as far as the going concern conclusion is concerned, in this slide, I have tried to highlight the effect of the effect of the going concern triggers of the entity. If the financial credentials of the entities deteriorate, then then there are obviously reporting implications in the audit report. So let's take the first situation where there are no significant doubt about going concern. In that case, obviously there is no reporting implications in the audit report. The entity would disclose that the financial statements have been prepared on a going concern basis. Next, there could be significant doubt about the entity's continuance of going concern, but there are mitigating factors, and those mitigating factors are very strong. let's say the entity is able to obtain a support letter. In that case as well, the financial statements would be prepared on a going concern basis. However, the auditor would still need to assess whether there are implications on the audit report. For example, if there is a if there is a uh, uh, indication that this situation would warrant an emphasis of matter in the audit report should also be evaluated by the auditor. Let's move to the next situation where there are significant doubts about going concern, but there are mitigating factors. But however, in this particular situation, the mitigating factors are not that strong. They are they do mitigate, but there are doubts whether those mitigating factors will ultimately take shape or not. For example, the entity has embarked on a debt restructuring plan, whether the lenders would ultimately accept to that plan or not is a question, or a forward-looking information that may not be known at present, and hence there could be a situation that there is a material uncertainty on going concern. This situation simply, as I explained, would mean that there are going concern triggers. However, the mitigating factors are not sufficient enough to mitigate the going concern situation fully. So in this case as well, the financial statements would be prepared on a going concern basis, but from an auditor's reporting angle, there has to be a mandatory paragraph relating to material uncertainty in the going concern. So if you would look at the auditing standard on going concern, it specifies what are those items that should be mentioned in the audit report where there is a material uncertainty. In the last situation, where the entity intends to liquidate or cease trading, or it doesn't have any realistic alternative to do so, in that case, obviously, the financial statements cannot be prepared on a going concern basis. This has to be prepared on an alternative basis of accounting, and that is an accounting consideration which the auditor should check with the management. In this case, the auditor may include an emphasis of matter just to highlight that the entity is not a going concern and they have followed the alternative basis of accounting when preparing the financial statements. Moving to the next topic, which is basically the effect of material misstatements on the audit opinion. So in this slide, I have tried to highlight what are those considerations that the auditor should take into consideration, and there could only be two circumstances. One that the financial statements as a whole are not free from material misstatement. So he has an observation or 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 a problem with a particular financial statement caption. So in that case, the auditor uh, should look at modifying the audit opinion. Or there could be another situation where the auditor is unable to obtain sufficient appropriate audit evidence. For example, when they are auditing the financial statement, they have not been able to obtain information around journal entries. So again, those kind of a limitation of scope would also impact the audit opinion of the auditor. Now, what could be those types of modifications? So, as far as the Indian standards on auditings are concerned, there could only be three outcomes. So, the modification can either be qualified, adverse, or a disclaimer. What I would like to highlight is that the type of modification is dependent whether the misstatement is material and whether the misstatement is pervasive. So if the misstatement is material and pervasive, then it would be an adverse opinion. If the misstatement is material but not pervasive, then the auditor opinion would be qualified. However, if the auditor is unable to obtain sufficient appropriate audited evidence, be it for the entire financial statements or for a particular aspect of the financial statement, uh, in that case, the auditor might assess whether the audit opinion has to be disclaimed. Now, as far as the pervasiveness is concerned, it is important to look at the definition of a pervasive misstatement. So, the standards on auditing states that it could be possible that the misstatement identified by the auditor are not are are not confined to a particular financial statement caption. So, for example, the misstatement is such that it is affecting multiple financial statements caption. For example, revenue, for example, expenses, for example, the balances of trade receivables, current liabilities, etc. So, in that case, obviously the misstatement is spread across the financial statements. Now, it could also be possible that the misstatement is confined to a particular financial statement caption. For example, uh, it is affecting the revenue caption only. All other captions of profit and loss account are correct. So, what the auditing standards requires the auditor to assess that in that case, please assess whether the misstatement is confined to a particular item, and if yes, whether it represents a substantial portion of the financial statements. So, in my example, if it affects revenue, let's see what are the percentage or to the extent the revenue is misstated, be it 70% or 80%, even though it is one particular financial statement caption and not spread across the financial statements, it would still be considered as a pervasive item. With respect to disclosures, whether they are fundamental to the understanding of the financial statements, if they are, and the misstatement is affecting the disclosures, then obviously the misstatement would be a pervasive to the financial statements. Now, I thought of explaining this pervasiveness matter through an example. Let's say there is a misstatement of a marketing provision expense. As a result, what would happen is that the profit for the year would get converted into a loss, right? And because of this, the liability side of the balance sheet is also affected to the extent of 80%. So if I apply the consideration which I just discussed about the pervasiveness of the misstatement, if the profit is converted into a loss, then I would expect that the misstatement is pervasive, even though it is limited to one particular caption, which in our example is the marketing expenses. But since PBT is a very important consideration for any particular stakeholder, and hence it will uh, hinder the the judgment making capacity of the stakeholder, I would believe that in this particular fact pattern, the misstatement is pervasive. Okay. Lastly, I would also like to look at the key audit matters, which the auditor is supposed to give in the audit report. So just to refresh our memory, key audit matters are those matters which are of most significance in the audit of financial statements. So at present, the key audit matters and reporting by the auditors are mandatory only for listed entities. So if the entities are listed, the auditor would need to assess whether during the course of its audit it has identified certain matters which are of most significance. Now, how would the auditor identify? So, normally a funnel approach is followed. So the auditor would first of all pick up the matters that were communicated to those charged with governance. From that set of information, the auditor will further filter it down to items which used or which required which required significant auditor's attention. Now, again, from that particular list, the auditor will pick up matters which are of most significance. So, if you would look at the standards on auditing, actually requires the auditor to uh, to communicate very significant matters which have been encountered by the auditor in the audit of the current year. I also thought of highlighting certain common camps which I could experience in the real estate sector. So one of the some of the most common scams relate to inventory valuation. This is largely due to the fact that inventory counts are carried out at periodic intervals. Considering the focus on safeguarding of inventory, it is quite relevant that inventories be counted at a much more frequent uh, time period, and also the fact that there are judgmental factors involved in computing inventory provision for its write-offs or for its shrinkage. So again, due to the judgmental matters as well as the frequent count of inventory verification, these were the reasons where the inventory valuation featured as a key audit matter in the audit report of retail uh, entities. Next important CAM, or the next common CAM which I could find out, is the revenue recognition of the entities, especially the accounting of loyalty schemes. Obviously, the accounting of the loyalty schemes involves significant judgments, forward-looking information, and assumptions. And this would obviously uh, engage the auditor for a quite uh, frequent manner, and hence the auditor would require to verify judgment, look at estimates, look at the estimation model. So the judgmental matters of the estimation would require a key audited matter in this case. Next common CAM for a retail sector is the impairment of brands. So let's say one particular entity has acquired brands from a third party. The cash flow projections, the discounting rate, the growth rate are all forward-looking information. As a result, while assessing the impairment of these purchased brands would involve significant judgment by the auditor. Lastly, recovery of deferred taxes also featured as one of the most common CAMs. This is again due to forward-looking information related to future taxable income and judgments and interpretation of tax regulations. Now, when an auditor is writing the key audit matters, certain consideration that the auditor might apply is is that the key audit matter should be very specific to a particular client. It should be more detailed. It should be granular. It should not be boilerplate. The auditor should refrain from using uh, a common type of CAM across its client. It should be very client specific. It should provide valuable insight to the reader. More specifically, it should tell the reader what are those considerations why the auditor paid so much attention on this particular topic. Now, as far as the reporting on key audit matters is concerned, the auditor is also required to state how those key audit matters were addressed. So, most importantly, the auditor is not required to repeat its entire audited program. The auditor should present only the most relevant procedures that have been carried out by the auditor. Those procedures should show the depth, extent, and skepticism implied by the auditor. It should also explain how those procedures are performed. Let's say the auditor should write uh, how the test of controls were performed on assessing the model for loyalty schemes. What are the procedures that have been performed on assessing the recoverability of deferred taxes? Again, it is always advisable that jargons and all should be eliminated. Uh, this would not only enhance the the readability of key audit matters, but also give a very insightful information about the audit procedures of the auditor. So that's all I had to cover. Anilji, if there are certain questions, I would be happy to take it.
Thank you so much, sir. Thank you so much for wonderful deliberation. We
Thank you,
have
Anilji.
gained a lot through your deliberation. Sir, due to the network issue and technical glitch, we are unable to fetch any question today.
Okay,
And what I will do, I will raise the questions and I will forward the questions to you through
sure,
mail.
sure,
Whatever will be the solution, we will forward to the concerned member, sir.
sure, Anilji.
Thank you so much, sir, for sparing your valuable time. On
Thank you,
behalf
Anilji.
of Auditing and Assurance Standard Board, I extend my heartiest thanks towards you, sir, for your sparing your valuable time and such a knowledgeable deliberation. Thank you so much, sir.
Thank you,
Thank you
Anilji.
so much.
Thank you.
Thank you, sir. Thank you. Namaste.